There's a look at Carvana shares. Why are they down so much?
Oh my God,
the
David!
latest is a story from brawling over a potential bankruptcy here.
Carvana is driving customers and the auto industry and how they are imploding, and they are going to take the industry down with them.
The used car seller known for car vending machines reached a debt restructuring deal today, lifting its stock price more than 40%.
August 10th, 2021. Carvana's stock hits $376.83 per share. The company is worth over $60 billion. Their glass-walled car vending machines have become icons of innovation. Wall Street analysts are calling them the Amazon of used cars. Founder Ernie Garcia III has just rung the opening bell at the New York Stock Exchange. 16 months later, that same stock trades below $4. The company has lost 99% of its value. Multiple states have banned them from selling cars. Creditors are circling, and the word on everyone's lips is bankruptcy.
It appears the day has finally come. Carvana on the brink of bankruptcy. Here's why you should care.
How did the most celebrated used car company in America collapse so spectacularly? The answer involves a pandemic, a $2.2 billion mistake, a father with a criminal past, and the kind of hubris that turns winners into cautionary tales. To understand what went wrong, you need to understand where Carvana came from. The company was founded in 2012 by Ernie Garcia III, a Stanford graduate who'd been working at his father's company, DriveTime. That father, Ernie Garcia II, had a colorful history. In 1990, he pleaded guilty to bank fraud for his role in the Lincoln savings and loan collapse, one of the most notorious financial scandals of the era. He served 3 years probation and filed for bankruptcy. But Garcia too rebuilt. He bought the bankrupt rental car company Ugly Duckling for under $1 million in 1991, transformed it into a used car retailer and financing company for subprime buyers, took it public in 1996, then private again in 2002, and renamed it DriveTime. The business model was straightforward: sell cars to people with bad credit and make money on the financing. By the time his son launched Carvana as a DriveTime subsidiary in 2012, the family understood one thing extremely well: how to sell cars to Americans, particularly Americans that traditional dealers might overlook. Garcia III brought two co-founders with him, Ryan Keaton and Ben Houston, but the startup capital came from DriveTime. At least $100 million in funding flowed from the father's company to the son's venture. In exchange, DriveTime would supply inventory and purchase the car loans that Carvana originated. It was textbook synergy. Some analysts would later call it financial engineering. The younger Garcia's innovation was simple but powerful. Why force people to haggle with salesmen on sweltering lots when they could buy a car from their couch? Carvana let customers browse online, secure financing, and either have the vehicle delivered or pick it up from those now famous multi-story vending machines. No pressure, no negotiation. Just insert a giant commemorative coin and watch your car descend. The company went public in 2017, and growth was steady. Then COVID-19 changed everything. The pandemic created perfect conditions for Carvana's model. Dealerships shuttered, consumers avoided public spaces. New car production ground to a halt as the global chip shortage strangled supply chains. Used car prices surged more than 40% between March 2020 and late 2021, the highest Edmunds had ever tracked. Carvana was positioned to capture all of it. Revenue exploded from $3.94 billion in 2019 to $5.6 billion in 2020, then more than doubled again to $12.8 billion in 2021. They sold 425,000 vehicles that year, 6 times more than their nearest online-only competitor. CarMax, the largest traditional used car retailer, only sold 9% of its vehicles online. Carvana seemed to be running laps around everyone. Their stock went from $30 in March 2020 to $376.83 by August 2021. At its peak, the company was worth more than Ford. Fortune 500 noticed. Carvana jumped 193 spots on the list in a single year. Business magazines ran glowing profiles. The narrative was irresistible. Plucky disruptor takes on sleazy car salesmen and wins. And here's where everything starts to unravel. If you're enjoying this breakdown so far, consider subscribing to the Brand Backstories. While Carvana was riding this wave, the Garcia family was cashing out. Ernie Garcia too began selling 30,000 shares daily through an automated trading plan. By September 2021, he'd offloaded more than $3.6 billion in stock, roughly 16% of his holdings. The timing in retrospect looks remarkably convenient because internally, cracks were forming. Carvana had built infrastructure assuming the pandemic boom would last forever. They opened new inspection centers. They hired aggressively. They accumulated massive inventory at peak prices. The company was preparing for a future that was about to evaporate. In May 2022, with storm clouds gathering, Carvana made a decision that still puzzles industry observers. They spent $2.2 billion to acquire ADESA, a wholesale vehicle auction business, with 56 locations spread across 4,000 acres. The deal required $3.275 billion in debt financing from JP Morgan and Citi. The logic, according to management, was that ADESA's facilities would let Carvana reconditioning capacity grow from 1.2 million units to over 3 million annually. On the exact same day they announced this massive expansion, they laid off 2,500 employees, roughly 12% of their workforce. They said they were aligning staffing with sales volumes, but the timing raised obvious questions. How could a company afford a $2.2 billion acquisition while simultaneously cutting staff because sales were slowing? The optics were brutal. Executives informed some workers of their termination via Zoom. CEO Ernie Garcia, III's email that morning told everyone layoffs were coming without specifying who. Employees lost access to internal systems before the formal announcement. One laid-off worker told CBS News the experience was very scary and that they had no support from anybody, but the layoffs were just the beginning of Carvana's problems. Throughout 2022, state after state started investigating Carvana for a fundamental failure. They weren't giving customers their titles. When you buy a car, you need a title to legally register and drive it. Carvana was selling vehicles faster than they could process the paperwork. Some customers waited 4 to 6 months, others waited longer than a year. Many received a parade of temporary, out-of-state registrations, some getting 5 or 6 consecutive temp tags while waiting for documents that never arrived. People got pulled over driving unregistered vehicles. Cars were impounded. In Ohio, nearly 200 complaints flooded the Attorney General's office from drivers forced to operate their vehicles illegally. One couple was stopped by police whose systems couldn't even verify their temporary registration. The officer told them to get in touch with Carvana, as if that would solve anything. Illinois suspended Carvana's dealer license, then suspended it again. Michigan accused them of 127 probation violations and sought to revoke their license entirely. North Carolina took action. So did Pennsylvania, Florida, Texas, and California. An executive at the company was charged with more than 80 criminal offenses in Illinois, including improper use of registrations and failure to transfer titles. The company that promised to make car buying stress-free had become a nightmare for thousands of customers. Meanwhile, the market turned with brutal efficiency. The Federal Reserve raised interest rates at the fastest pace in decades, making car loans significantly more expensive. Used car prices fell more than 20% from their January 2022 peak, according to the Manheim Used Vehicle Value Index. Consumers who'd been priced out of new vehicles suddenly had options again, and traditional dealerships had finally built out their own online capabilities. Carvana found itself holding massive inventory purchased at peak prices, watching that inventory depreciate while paying interest on the debt they'd used to buy it. The first quarter of 2022 brought a $506 million loss, 6 times worse than the same period a year earlier. The company was burning through $593 million in cash during those 3 months alone. By November 2022, Carvana reported a $508 million quarterly loss. Their stock, which had been $376.83 just 15 months earlier, dropped below $4 to an all-time low of $3.55. Wall Street analysts slashed price targets to $1. Bank of America warned the company would run out of cash by the end of 2023. In December 2022, Carvana's largest creditors, including Apollo Global Management and PIMCO, signed a cooperation agreement to coordinate potential restructuring. Trading was halted as shares plunged 43% in a single day. The company's market cap had fallen from $60 billion to roughly $700 million, a collapse of more than 98%. But here's where the story takes an unexpected turn. Carvana didn't file for bankruptcy. In September 2023, a group of creditors led by Apollo Global Management agreed to a deal that reduced Carvana's total debt load by more than $1.2 billion. The company slashed $1.1 billion in annual expenses through layoffs and operational cuts. They introduced new AI-powered software called Carly to streamline vehicle reconditioning, and slowly, improbably, they started to recover. The turnaround required sacrifice, thousands lost jobs. The company retreated from its growth at all cost mentality and focused on profitability metrics for the first time in its history. Garcia III later told CNBC that the experience makes you better, even if it's no fun when you're in it. By early 2024, Carvana reported its first profitable quarter since going public. Their stock, which had hit $3.55, began climbing. As of late 2024, shares were above $190. The market cap had rebounded past $40 billion. Does that mean the Carvana story has a happy ending? Not necessarily. In January 2025, Hindenburg Research, the short seller known for exposing corporate fraud at companies like Nikola and Adani, released a damning report calling Carvana's turnaround a mirage. After 4 months of investigation, including 49 interviews with former employees, industry experts, and competitors, they allege the recovery was fueled by accounting manipulation and questionable transactions with related parties. Specifically, they pointed to $800 million in loan sales to what they called a suspected undisclosed related party. They questioned why Carvana's profitability metrics improved so dramatically, even as used car prices fell 12% since their turnaround plan began. They noted that nearly 44% of Carvana's loan portfolio consists of subprime borrowers, with some tranches carrying credit scores below 580. What the Consumer Financial Protection Bureau classifies as deep subprime, and they kept coming back to the relationship between father and son. Ernie Garcia II, despite his criminal history, remains Carvana's largest shareholder with roughly 21% economic interest. His company Drive Time still services Carvana's loans and provides various back-end services. The exact nature of these arrangements remains opaque because Drive Time is private. Carvana denied the allegations, but the fundamental questions about the company's relationship with its founder's father, about the sustainability of its business model, about whether growth was ever more than a family wealth extraction machine, those questions remain unanswered. What's undeniable is this: Carvana's rise and near death reveals something important about how we evaluate disruption. The same features that made them revolutionary, the speed, the scale, the willingness to grow at any cost, became liabilities the moment conditions changed. They built a company optimized for a world that existed for exactly 18 months. For those of you who want more stories about ambition, disaster, and the companies that shaped our world, subscribe to the Brand Backstories. I'll see you in the next one.